Yo, what is going on, guys? Welcome to Delta Rules. In today's video, we're going to be talking about option Greeks. This will be our second course. Like I said, guys, there will be much more coming after this one. Now, keep in mind, the opinions and ideas presented by Delta Rules and myself are for informational and educational purposes only and should not be constructed to represent trading or investment advice. None of the information on this channel constitutes a recommendation that any particular security, portfolio, transaction, or investment strategy is suitable for any specific person. Options involve risk and are not suitable for all investors. My objective today will be to explain to you the option Greeks. We will talk about delta, theta, gamma, and vega. We will also talk about the effects that they will have on the option contracts, on the price of the option contracts. And I'll also give you real life examples as far as to where you could find them on Thinkorswim and Robinhood. All right, so what is delta? Delta in option terms refers to the dollar move that the option contract will make for every dollar that the stock moves up or down. This means that if the delta, let's say, is 0.15, because it will be represented in numbers. If the delta is 0.15 and your option contract is worth 50 cents, your option contract will go to 65 cents if it goes up a dollar and or 35 cents if it goes down by a dollar. So it is represented in numbers, so 0.15, but you could also take it as pretty much a dollar amount. So it will be 15 cents that it will move up or down on the contract. Of course, like we know in real life, that is $15. So your contract, when I say the contract is worth 50 cents, that is $50. So 50 cents per represented share times 100, and that $50. Now, the higher the delta, the closer to the money your option will be, and vice versa. Now, remember, being in the money is being above the strike price on a call and below the strike price on a put. That is pretty much it. The higher or the deeper you are in the money, the higher the delta is going to be. Now on the right hand side, I figured I'd show you how this looks in Robinhood. Now, guys, like I said, uh, I don't make any recommendations. That is just a stock, that I have an option for. I just wanted to show you. I don't want to cut it out because I didn't want to take the picture out. It wouldn't look like Robinhood if I cut everything out. So in this situation, the delta, whenever you purchase a contract, this is where you will see it. As soon as you open up the contract, you're going to scroll down, you're going to see the Greeks, and that is your delta, and that is the amount that the contract, like let's say my contract is a 53 cents. You can see that at the top it says ICE 53 cents. So the delta is 14 cents. So 0.14. So that means that anytime that's my stock, ICE, goes up a dollar, I'm making 14 cents or $14 in real life. And that is pretty much it. That is where you find it in Robinhood. I will show you how to find it also before you buy the contract in Robinhood, which is very important because you want to know what the delta, gamma, theta, and vega is before you buy the contract to figure if it's an expensive contract or if it's a cheap contract and it's a good contract that you should be able to get into. So on the next slide, I'm going to show you an option chains for Thinkorswim. Like I said, I'm going to be engraving that in your head, the option chains for Thinkorswim, and I'm also going to show you how to see the Greeks before you buy on Robinhood. All right, so here is the option chain. So on the left hand side, the first one of the three is I'm marking the delta where it will be on the option chain on Thinkorswim. Now, keep in mind, Thinkorswim, you could customize this however you want. You can have your delta showing, you can not have your delta showing, you can have any other study showing in there, and that's why I'm a big advocate of Thinkorswim or any other platform that shows you the amount of information that Thinkorswim does. So on the middle I showed you how to actually see the Greeks before you buy the contract in Robinhood. So of course you'll hit trade and then you'll hit trade options. You'll look for the option that you want. And then when you click on that option, this is the screen that's going to come up, the one in the middle. It says, of course it shows you, we talked about it, the bid, which is the lowest that or the highest that a buyer is willing to pay, and the ask, which correction on the previous video I told you that it was the highest that a seller is willing to sell. It's not, is the lowest that a seller is willing to sell. So the bid, the highest that a buyer is willing to buy, the ask, the lowest that a seller is willing to sell. So you click on the bid and ask, and this will show you the picture on the right hand side, which is all of the stats. And we will get into volume, we will get into open interest. That is the most important thing in options. I could tell you that. I was gonna say one of the most, but no, that is the most important things in options, in my view, because that lets us know what the big guys are doing. That lets us know how many options are actually traded. What's the sentiment of the market. Is it more calls, is it more puts, things like that. So, and there you go. So you, on the bottom, you can see the Greeks, you can see the delta, gamma, theta, vega. We will go over this, in each slide we'll go over the delta, the gamma, the theta, and the vega. All right, so next we'll be talking about gamma. Now, gamma in an option is the amount of money that delta goes up for every dollar move on the stock. Now, for example, let's say the delta of your option is 30 cents and the gamma is 8 cents. That means that when the stock goes up or down by a dollar, the delta will go up or down by 8 cents, meaning that 0.38 if it goes up by a dollar and 0.22 if it goes down by a dollar. That is pretty much what the gamma does. The gamma adds to the delta for every dollar that the stock goes up or down. All right, now on the right hand side, I went ahead and illustrated for you where to find the gamma whenever you have the contract already in Robinhood. Now, as you can see, the gamma is 3 cents, the delta is 14. Whenever the stock goes up a dollar, the delta will go up to 0.17. And it's most likely the fact that the gamma will also increase in money size. So that's how it goes. The gamma adds or subtracts to the delta. So if the stock were to go down, the gamma will go to 0.11. That is how that works. Now here I'm showing you pretty much once again where it's located on the option chain in Robinhood. Like I said, Robinhood, what I'm showing you in Robinhood is pretty much to get the option chain across. You know, the data's on the right, the strike price is on the middle. And that's how you look at the option chain on Robinhood. As far as how you could, where that gamma is located, you could put that gamma wherever you want. Robinhood literally lets you pull up the settings and organize where you want things to be. As far as Robinhood goes in the middle, same thing. Whenever you're about to get the contract, you click on the bid and ask, and on the right hand side, the picture on the right hand side, you can see that the gamma for the contract that you're about to buy is 1. You can see that the delta is 11. So you know that any time that the stock goes up by a dollar, that delta is going to go up by a dollar. Or, if it goes down, the delta is going to go down by a dollar. All right, so now we'll be talking about option theta. Now, theta in option terms is the amount of money the contract loses every day for simply holding it. So it's just the amount of money that it loses every day for you holding that contract. For example, if you have a call that is worth 60 cents, of course, times 100, $60, and the theta of that option is 0.07, then you're losing 7 cents, 0.07 cents, or $7 in real terms every day for holding that contract. The longer the time to expiration, the lower the theta will be. This means that it's not as risky holding a contract that has time over a contract that doesn't have as much time. When buying options, remember, theta is just not your friend. Theta is the seller's friend. Theta is the friend of the person that sold you that option, because they know it will keep depreciating, and that theta, they will keep on collecting that little, how you can see it on the right hand side, the little $4 a day. They'll keep on collecting as long as the stock doesn't do much. So remember, theta is not your friend. Delta is your friend, and that's why Delta rules. Now, once again, I went ahead and showed you the locations as far as to where you could find data on the option chain on Thinkorswim. Once again, you can put that everywhere you want in Thinkorswim. In the middle, I went ahead and showed you how it looks before you're about to buy the contract. You're going to click on the bid and ask price, and on the right-hand side, it will show you the data. Now, guys, I completely forgot to mention, whenever you see, you're gonna see delta, the amount of the amount is supposed to go up, the option is supposed to go up for each dollar move on the stock. It's negative is if it's a put. So if it's a put, you're gonna see that delta, it's negative. So remember that. Now remember, the fundamentals stay the same. If it's a put, and then if you see a negative, it's still going to be the amount of dollar move that your option will move for every dollar move on the stock. It's still going to be the same concept, even if it's negative. All right, so now we'll be talking about Vega. Vega is a little bit in this situation, I would say, more advanced due to the fact that it has to do a little bit with volatility, a little bit, no, a lot of volatility. Vega is how sensitive your option is to volatility. So Vega, as you see it on the right hand side, is 0.05. Vega is the amount of money in dollars, so 5 cents in dollars, or $5 times 100, like I said, in dollars, that the option price will move for every point change on implied volatility. Now, we will talk about volatility in a different course. Like I said, I want to be able to get into volatility because it is very important. Now, in simple terms, IV, or implied volatility, is a sentiment of the market, or how much the market makers think that the stock will go up or down in the short and long term. It is simply what the expected move for the stock is. So it's usually represented in percentage. Thinkorswim, if you look at Thinkorswim will give it to you in dollar amount. Like, it is expected to move this much. Like, this stock is $150. It is expected to move by this option expiration this amount of money, and that's usually how it's actually showed, at least in Thinkorswim. As far as implied volatility goes on Robinhood, you can see that on the right hand side there. It says implied volatility 28.98%, and then 94%. So we'll be talking about this later. Like I said, I will be getting into this quite a bit. We'll be talking about different types of volatilities as well. All right, so for example, to put Vega in perspective, if the IV of a stock is currently at 50% and the Vega is at 0.9 or 0.09, when the IV goes to 51%, the option will go up by 0.09 or 9 cents, or really $9 in real terms. Now, of course, if the IV goes down to 49%, of course, the option will go down by the 9 cents or the $9. Now, same applies here. I'm showing you pretty much once again, the Thinkorswim platform option chain. I'm pretty much showing you the Vega there in red. And once again, you could customize Thinkorswim. In the middle, you have like I said, where you can find it in Robinhood. You click the bid and ask. On the right-hand side, it'll show you, whenever you click on that bid and ask, it'll show you all of the information that's on the right-hand side. And that's the Vega that's selected. All right, so what is next? On our next course, we will be talking about option prices and what factors fall into them. Now, guys, uh, if you've watched, if you're gonna watch any course that I'm going to put out, this is gonna be the one. I'm gonna make sure that I could get into option prices as deeply as I can, because we need to make sure that we're buying suitable contracts. I mean, we need to make sure that we're buying contracts that are not too expensive. Because if we buy contracts that are too expensive and the volatility is too high, which is, what would make that contract very expensive, it, you're 95% guaranteed to lose money, and that's the main thing. The next course is probably going to be the most important course I will be dropping. I will be talking about a volume on an option. I will be talking about open interest on an option. I'll be talking about implied volatility, historical volatility, which is, the historical volatility of the stock. um, uh, we will go deep into the option prices on my next course. All right, so thank you guys so much for watching. Make sure to like and subscribe if you're liking the videos that I'm putting out. There's going to be a lot more like this, guys. Like I said, I'm going to be getting into Thinkorswim as well. Uh, by the end of this whole course, I'm going to make sure that you guys, like I said, are able to just simply look at an option chain and say, hey, the market thinks the stock, the full market as a whole, people think the stock is going up more than they think it's going down, or they think it's going down more than they think it's going up. We're going to be able to see what the big institutions are doing. We're going to be able to see where the big orders are coming in. I'm going to teach you about all of the filters that you're able to set up in Thinkorswim. Like I said, guys, I'm gonna try to see, I'm gonna try to get Thinkorswim through you guys' head to make sure that you guys have a different broker. I don't really use any other broker. I don't use E-Trade. I don't use, Schwab. Uh, you know, any other broker that I just don't use them. My thing is Thinkorswim. I just don't see myself using anything else. So I will teach you guys about Thinkorswim. I'm sure you guys are gonna like it the way I do. Thank you guys so much for watching. You guys have a wonderful day. Stay safe out there. I love you guys.